Welcome in, and thank you for joining us for another episode of Healthy, Wealthy, and Wise Retirement. Your host, Lauren Sherman, is a certified financial planner and owner of the flat fee firm Integrity Wealth Management. He curates each episode with you in mind. Whether a work optional lifestyle is on the horizon or you're already there, this show has something for you. With that, listen in, and I hope you enjoy the show.
Welcome in for another Healthy, Wealthy, and Wise Retirement. Of course, I am your host, Lauren Sherman, and today I had a fun conversation with my good friend, Alex Murguia, who I will have a little bit of intro for him as we jump into the podcast. But he's a really smart guy and has a lot of great wisdom to share with us. Some of what we cover today, we kick off talking about market volatility, both from a perspective of what we hear and see in the media, but also from an academic perspective, which Alex is well prepared to share with us. We also touch on what some of the relevant market drivers are, and then perhaps whether or not they are even worthwhile of tracking in our own portfolio. And then this next one you might find fascinating. We talk about how much the market has to move in totality to net us the return that we see at the end of the year. It's quite fascinating how much the market swings up and down, because I think sometimes we see, okay, the market's supposed to return, let's call it 8%, 10% per year, but in reality, things look quite a bit different than a smooth ride up to that 8 or 10% return. And often we're not getting anywhere near 8 or 10%. We might come in way above that and way below it one year and the next to get to that average. So we talk a little bit about that, and the range that the market actually needs to, or that it does, swing both directions to get those returns is quite fascinating. We also talk a little bit about setting expectations, how Alex goes about that with his clients, as far as how to describe, setting expectations for a certain percentage of return, for example. And then Alex has a doctorate in psychology, so he was the perfect person to ask about different biases that we all hold. And we get into loss aversion, anchoring, action bias, survivorship bias. There's a handful of biases that Alex is has the background to discuss in more detail, and that's a fascinating conversation as well. And then I also reference a conversation that they had on their own podcast with Dr. Daniel Crosby recently. So I think I'll link that one in the show notes. And I actually interviewed Daniel Crosby a while back as well, and his content is always worth revisiting. I think that will wrap it up for this episode, and then we're going to break this conversation into two parts. So we'll have part 2 for you coming in 2 weeks, where we will circle back, talk about some of the different technology that they use, talk about retirement income styles and how we're all a little bit different in how we should build our retirement income plan, and how rather than just kind of shooting from the hip, Alex and his business partner Wade have come up with a technology that helps us get there. So I'll actually link that in the show notes too, of if you want to go ahead and take your own free questionnaire, it'll tell you what type of retirement income best fits your style. And there's 4 different quadrants that you can fall into. So I'll give everybody access to that. I think that's all I have for today. So let's jump right in with Alex Murguia. Alex Murguia, Ph.D., is the CEO of Retirement Researcher and Managing Director of McLean Asset Management, an investment advisory firm based in Tysons, Virginia. Alex has written in numerous industry journals such as the Journal of Financial Planning and has been recognized nationally for his work. He's also been interviewed and quoted for his thoughts about retirement, financial technology, and wealth management. He's been published in the New York Times, Wall Street Journal, and others, and is a frequent speaker at financial conferences. Alex has also founded a financial planning software used across the industry. We'll actually touch on that a little bit later, as this is something that I use within my own practice as well. And then finally, at home, Alex has a wife, Christy, 3 boys, and a wild bunny running around in the backyard named Mandy. I don't know, Alex, how did we do?
Pretty good. Pretty good.
All right. I took some of that off your bio, and I thought, oh gosh, I hope as I'm reading this that the Mandy is still around and kicking, right?
I hope so too. I don't know. I think so. More to follow. More to follow.
Fair enough. Well, let's kick this off with starting with market volatility. From an academic perspective, people talk about market volatility a lot, and I think there's kind of two sides to this. Maybe you can speak to it academically, and then also how market volatility is viewed through the eyes of media, TV, that sort of thing.
Well, I mean, from a pure academic standpoint, volatility is simply just the variance of the returns, right? What's the range of returns for any given period, and sort of operationalize that into a metric that we can sort of come to agreement with that this represents volatility. I mean, we go with standard deviation right now when you're looking at a portfolio. But I think that's a cold, calculating way, right, of viewing this. I mean, ultimately, for folks watching TV, market volatility is probably best described as periods of significant but unpredictable price movements in the financial markets. We had that starting in April when we heard the news of the financial tariffs. I mean, we had to deal with economic considerations such as, what's going on with the tech sectors and inflation. We had to deal with government policies, tariffs, what's going on there, what's the Fed going to do on interest rates. And the global events are still relevant, such as the war of Ukraine and the pandemic. And so from that standpoint, I think people view that as periods of significant and unpredictable price movement that's caused by all these sort of factors, which, frankly, pure academic, it's just movements of the market up or down. But the reality is there's more visceral components going on here.
Sure. And I think not to be a broken record from what I've said maybe in past episodes, but the media's job is not to calm fears. It's to kind of stoke the flames and get everybody excited about something. So I think, often there's a lot of noise around markets and maybe not much of a solution provided particularly when it's coming from, TV segments and stuff.
No, Lauren, I agree. I mean, ultimately, they're in the business of getting eyeballs, not necessarily dispensing the best possible advice. And the reality is, let's say there was a special during the market volatility. What to do with your portfolio now to make sure that you're up to date on tariffs? And they provided litany of things that you should have been doing. And 3 months later, we're kind of back to where we were, and then some. A few months later, I mean, it's not like you're going to go back to that publication and say, "Hey, you were wrong." You just move on to the next storyline.
Right. So with that, people do still seem to describe the market as particularly volatile right now as we're recording this. And I guess I'm just curious if you would agree, or if we truly ever have kind of quote unquote normal market conditions, because, uncertainty, I guess kind of by definition, is what we get when we're invested in the market, right?
Yeah, it's kind of what we sign up for. I mean, just to bring a little bit of perspective here, sometimes folks refer to what's called as the fear gauge, the VIX index. And that's an index that's calculated by, in real time by the Chicago Board of Exchange, and it provides a snapshot, if you will, of market expectations for volatility over the next 30 days, because they're viewing the price of options and they're calculating, how that translates to their index price. During April, when the tariff talks were really out there and news cycle a day, if you will, the VIX hovered around 60 at its highest point. Right now, it's around 18. So from that standpoint, I mean, you're not getting the sense of the headline volatility kind of thing with regards to the market. But from a general standpoint, yeah, I mean, the market is significantly volatile right now.
Maybe kind of depends on what phase of life you're in, because if you're maybe just getting to retirement, maybe it's a little bit more top of mind and worrisome. And then I guess maybe where you're getting your news as well, right?
Yeah, no, you're absolutely right. I mean, Lauren, when you really think about it, at the end of the day, the valence of market volatility depends on what life cycle you're in. If you're accumulating assets and you're a disciplined enough investor, you see it as a time to get in while prices are low. If there is
Sure.
volatility on the downside, all of a sudden you can contribute, you get more of a proportionate share, etc. And you're absolutely right. If you're getting into that frame of the fragile decade, which is 5 years before and 5 years after retirement, that area has a disproportionate effect on your ability to take income. So if there is a downward market cycle around that time period and you're taking out assets, then yeah, that would be a period of great stress.
Yeah. Yeah. So maybe you can speak to some of the more relevant, I guess you'd call them market drivers from your perspective. And then perhaps even whether it's worthwhile trying to gauge those of what truly is driving the market. If it's, not this or that, maybe what we
Sure.
see in the news, but what else is relevant if I was an investor, and what can I even do about it?
Well, it's easy to know what the issues are, right? Right, Lauren. It's one of those items where it's kind of easy to be armchair quarterback after the day's happened and say this is what happened. The
Yeah.
reality is that news moves in randomly, and so the ability to forecast what that news will be from one day to the next, it's just a bad task to do. But the reality is, what we're seeing now is news about tariffs are coming in, news about how that may or may not affect inflation or to what extent it will, and then news about how the confluence of those two, a slowing economic cycles because of the tariffs, yet coupled with higher inflation rates because of the slowdown and the tariffs, stagflation. And so those are the headlines
Mhm.
that seem to be making way right now, but information's just coming in irregularly and randomly. And to your point, you can't really do anything about it. And so
Yeah.
to worry about that, I think is a recipe to, that will make you want to do something, from a action bias standpoint. And sometimes that's just not the best course to take.
Right. And we always hear so much on the kind of negative side of that, but on the flip side of one of the market drivers are the, potentially the innovation and the new technology and every, where that's going and being so much more productive with our time. Um, Maybe we hear less about that. I feel like I hear a lot about it, but maybe not so much in your typical news cycle.
No, you're right. I don't disagree in terms of how the innovations will lead to expanded ability to be more productive in the workforce in a more effective manner. I don't I don't see how that's a bad thing in a similar
Yeah.
way to how the internet ushered in a whole new way of working.
Yeah. Yeah, it's always scary a little bit initially of saying, oh, well, we're going to lose like the X percentage of jobs to AI, for example. But, in reality, if we looked backwards, the internet revolution was not a bad thing for productivity. It's not like we just change where our services are needed, I guess I'd say.
Yeah, it ushers in change, right? And as human beings, change is somewhat of a discomforting thought,
Yeah.
especially at certain times of your career where maybe a retraining is in order or something along those lines. But so there are those fears, and those are very real concerns. But ultimately, if you look at all these revolutions that have taken place, it seems to me that humans find a way. It seems to me that we end up being better off, not worse off.
Right. Yeah, that starts to touch on the human psychology of change being just something that we all struggle so much with. But that jumps right into my next question here. Something I found fascinating in your podcast, Conversations with Wade Pfau, on your own show, which we'll have linked in the show notes here, is the absolute volume of market movements in
Oh
in
yeah.
one day in relation to the actual gain or loss that we have at the end of that day or the end of that year. So can you speak a little bit to that and kind of the point that you're driving home with that?
Yeah, the larger point is can you can always find a reason for why the markets moved up and markets moved down, and really, when you find a reason afterwards, it gives you the sense that you can kind of know what's going to happen the next day and so forth. And so we really just wanted to say, does any return on any particular day identify some signal that can be used for future trading days, sort of separating the signal from the noise. And it was, basic idea that trying to follow the market on a daily basis is going to be a fool's errand because it's going to drive you batty, always, always guessing. And so, simply put, I think we did this April 1st. So going back 10 years previous to that, 2015 to April 2020 to April 2025, the Dow Jones at that time, and I'm doing this in raw numbers because I'm doing it from memory, returned about 24,500 points. Okay, so over that 10-year period, the Dow gained 24,500 points. At the time that we did this, what we did is we took, let's say, if from one day to the next, the Dow moved up 200 points, but then the next day it went down 200 points, those are 400 absolute points, even though it netted zero. And this is end of day return. There's many intraday highs and intraday lows, but
true.
We had to
You can't even take that into consideration.
Exactly. So let's assume it moved up at the end of the day by 200, and then the next day it went down 200. Absolute terms 400, but net zero. So by taking all those absolute number days, like if it went up 500, down 500, that's 1,000 points. So by taking the number of those point days and adding them all up, we ended up with 490,000 points. So to move 24,500 points, you had to sit through 490,000 points of noise. Just do the math on that. That's roughly, for every 1 point up, it's 20 points of up or down.
Wow.
You net out 1 point, for 20 points of movement. That's a lot of noise. And so the whole message was, if you're going to sort of let the Dow or the market's daily price movement determine how you're going to feel that day, about your retirement, maybe you're doing it the wrong way.
Yeah. Yeah, and I work mostly with people just gearing up for retirement in those few years prior to or after retirement. And speaking to your previous point about having an action bias, all of a sudden people have a heck of a lot more time on their hands too when they're retired. So we have this feeling that something's happening, we should be reacting to it.
Yeah.
And actually, I have a list of those we're going to cover here in a second. But how do you go about setting expectations when you have conversations with clients? Because if you're shooting for, let's say, a 7-8% return on an annual basis, depending on the strategy, we're rarely going to hit that exactly. So kind of to that point of having these wild fluctuations to get to that final net return, even on an annual basis, it's not going to work out all that great from what you're shooting for. So how do you have that conversation, and how do you kind of set those expectations with clients in your own firm?
I mean, really, at the end of the day, we don't feel we can predict what's going to happen next in the market. We're not necessarily forecasting. That's the bad news. The good news is you don't need to predict to be able to have a positive investment experience. Our job as advisors or as clients investing in the market is more to harvest the returns that are available. Like a farmer doesn't create, you're just harvesting the returns that are available because ultimately the market doesn't owe you a retirement. That's one of these things. The market is not built for somebody's retirement. The markets are a function of capitalism, right? Yeah. And we're kind of collectively riding off the coattails of capitalism. But at the end of the day, the market serves as a form of financing for the individuals' companies within it. So what we're doing is participating in that. And with that participation comes the acknowledgement that there will be risk.
Right. Yeah, and it's a heck of a lot easier to have those conversations earlier or maybe before someone's a client than when you're right in the thick of the mess, right?
Yeah, well, I mean, it really is. I mean, Look, I'm sure there's many people that hear that story and hear our reasoning for what we think about the markets, and maybe they don't become clients, but I can live with that because the reality is we have to set proper expectations, and the expectation is to your point. Look, if any financial plan can work if you give it a 15% return, right? But the reality is you have to work within the realm of practicality, and that just requires the returns that are in the original, let's say anywhere from 6-7%. Anything
Right.
beyond that, any plan will get dicey. And I think any
Right.
advisor worth their grain of salt would tell you something like that too, right?
Yeah. Yeah. Versus just over promising and then end up under delivering. But sometimes that's, advisors are still guilty sometimes of tripping over themselves and over promising to get a client and then trying to
Right.
keep that person happy. Good luck,
And I mean, with my mentors as I got into the business, one of the, I mean, it happens to be absolutely right, but to me, it was something that stuck with me is if you quote unquote sell them on the returns, you're going to lose them on the returns
Right.
because that's something you just cannot control.
Yeah. That's a good point. Let's jump into a few of these I jotted down. So you have a doctorate in psychology.
That's correct.
So I thought you'd be the perfect person to ask about biases, as we all have as investors. So I've listed a few. Let's see if we can walk through some of these, and perhaps you can add your own commentary of what you see most often, and maybe, I don't know if this will be the same answer, but also maybe what has the largest impact from your perspective. So you already mentioned one of them, action bias, of basically feeling like you have to do something, loss aversion, anchoring, survivorship bias, gambler's fallacy. Which ones do you want to tackle that
Well, I'd
you'd
say
like to talk about?
I can just go through them fairly quickly, but I mean the granddaddy of them all, and frankly, the risk-free rate you can make the case is based on this to a large extent. Is loss aversion that pretty much begins to drive everything else, and that's the positive, the negative valence is described as the emotional tenor of something. The negative valence of a loss is about 2.5 times more than that of a gain, and so if you're built to avoid losses, then investing in the market is a tough thing to be able to stomach, if you will.
Yeah.
And that's easy. I mean, we were wired for evolution. We were wired to survive. We weren't necessarily wired to be great investors. And so, from that standpoint, I mean, we can just loss aversion can be covered in like five courses. But the reality is that guides many things. And if you think about finance, the thing that guides everything is the risk-free rate, which is, how do you satisfy your loss aversion?
Right.
So I think that one's the biggest one of them all. I mean, the one that gives people the most confusion when it becomes, in my sense, but when it becomes a active versus passive debate, like,
Yeah.
should I be a stock picker or should I just index? From that standpoint, is survivorship bias. And that's when someone making the case for active management will point to some sort of successful fund manager. And the reality is from a survivorship bias, they forget what's really going on here. And if that, in any normal distribution, you are going to get a set of random folks really outperforming and doing well. The fact that less people than chance do well indicate that there's more going on here. Not only is there no like evidence stability for folks to outperform beyond random chance, but because of fees and whatnot, you get even less than what would be predicted by chance.
Sure.
So it's just an interesting thing that I think things are conveniently forgotten about.
An example I've used to explain that would be like, if you had 100 people in a room and you ask everybody to flip a quarter 10 times,
Exactly.
and someone got it heads 8 times in a row, or 8 out of 10 times, I should say, 9 out of 10 times even, you're maybe not going to be overly impressed. But if you only looked at that one person and said, gosh, are they doing something special? Well, when you look at the number as a whole, you can mathematically describe, no, they're not. But when you just have that information in front of you and that's all you have, and then you put tons of marketing dollars behind that,
Yeah,
it can
yeah,
be a
yeah.
pretty compelling story.
And yeah, but what you find is now you ask the 30 people to flip coins again, or who the 100
Right.
people in the room to flip coins again. What are the odds that the person that won the first time will get 18 in a row again, or whatever number you said again,
Yeah.
8 or none? There's no persistency of this kind of stuff as well. So it's just one of
Only in
those items.
hindsight.
So to me, loss aversion, survivorship bias are huge. Action bias, it's one of these things that in our industry, money is like soap. The more you touch it, the less of it there is, right? And so you always have this feeling that I got to do something, I got to do something, I got to do something. When in reality, the best move many times in investing, assuming that there was a financial plan in place, assuming that the investments were originally done, with the right contextual
Right.
underpinnings, etc. Once that is once that has taken place, the toughest part has already been done. From
Yeah.
there, it's really a matter of pruning or a matter of interjecting the consequences of a financial plan into the investments, but it's not necessarily significantly more than that.
I think as advisors, we can be guilty of this too. So sometimes we have to turn the microscope back on ourselves and our own practice and make sure we're not succumbing to these too. Because as an advisor, in some ways, it's almost easier, particularly that last one you mentioned of the action bias, to just go with the flow and go with that and say, hey, yeah, we're going to make a bunch of trades to try to, and then you can justify them because the client's kind of already wanting that and you're just going with the momentum rather than sometimes the right thing to do is having the hard conversation, trying to go against the flow of the water instead of just go with it.
Absolutely, Lauren. Absolutely.
Yeah. One you didn't, I don't know, maybe we skipped was anchoring. Did you have anything on that one? I think often, like when I'm just thinking of, so often people will look at the price of a holding or a stock or something when they bought it. And that's like the most important thing is that the price at that moment, and they're really anchored to that. But maybe you have a different perspective or
No,
analogy for
I
that.
would add that also works on the negative side on the other end, where let's say they're holding on to a stock and they think the fair value is the price they originally bought it at, when
Mm-hmm.
things have no longer things have happened that no longer make that the case, and all of a sudden they're holding on to a loser much longer than they ever would have, simply because what they paid for it they anchor as the right value for that.
Right. Yeah, that's one that hits home a little bit because I've had to like, you kind of have to tell yourself sometimes like, oh, this doesn't mean it's coming back just because it's down from what I bought it
Yeah,
at.
exactly, exactly.
Yeah. Once again, to kind of flipping the microscope on ourselves
Look, we're
versus
human
just
beings,
talking
right?
about other people.
No, but we're
Yeah,
humans. I mean, it goes without saying. And something about the biases is just knowing about them doesn't mean that you can overcome them. It,
sure.
I mean, what you have to do is give yourself a framework. And if you can work within a framework, then you give yourself the best chance of adjusting to these biases. But to think that you can just by brute force change your behavior, no, because we've been wired for many of these things to help us survive.
Yeah.
These are the outcomes of just having mental shortcuts, and we would need mental shortcuts. If not, we wouldn't be able to carry on our day. I think humans make about one decision every. I mean, it's something weird, like one decision every 2 seconds, or something odd like that. You
Yeah.
don't think about it though; you just do them. And
Yeah.
so the way to do them without thinking about it is having these shortcuts. These shortcuts manifest themselves through these biases because they're just quick and dirties.
Mm-hmm.
So it's one of these things. They've helped us survive. They just haven't done a very good job in making us great investors.
Right. Yeah, I was fascinated with when you and Wade had Daniel Crosby on the show, and I
Sure.
interviewed him a while back before his last book came out. But I could listen to his talks all day. He's just really, really smart guy and can dive into this stuff in detail. And I
100%.
remember him talking about how even advisors really should have their own advisor because we get to see the forest through the trees sort of analogy of like, we get so into this ourselves that when it's our own money, that can still be a challenge,
Well,
even
I
for
mean,
us.
I think because it's so emotionally charged because it's now your situation. To
Hmm.
some extent, it's easier to dispense advice in a more objective manner, right? When it's not necessarily you. When it's you, then it's hard for you to disentangle your own emotions from it, so it makes it much more murkier to provide the right answer.
Yeah. And what I've found too is like you can't check that box as an advisor when you're talking to your clients, whether it's about markets or biases or any of that. It has to be an ongoing conversation because it's kind of like a rubber band. Like you kind of slingshot and back to default at a certain point if you haven't had the conversation in a year. And you do end up having, maybe I'm curious if you've experienced this yourself, but it feels like you do have to kind of have those conversations and reiterate that, because even though logically we can understand it, you kind of have to hammer it home often.
100%.
All right. I hate to jump in right here, but we are going to put a pin in the conversation for today, and we'll wrap this up in a couple of weeks with Alex. That's going to be a fun conversation. We're going to talk about the technology that he and Wade Pfau created called RISA, where you can match your retirement income style with the proper strategies so that you're not just going with the flow of whatever the advisor likes to do, but it's actually matching your personality and your style. So that'll be a fun conversation. We're going to talk a little bit about how they view tolerance for market turbulence, and I guess just how they model that in their retirement plans. We'll also talk a little bit about beyond the income strategies, what should we be doing as investors, and maybe, I guess it's easy to talk about what we do wrong. That's maybe first part of the conversation that we talked a little bit about today. So that'll be a little bit of how should we do things the right way. And then we wrap up with a discussion about what's called your probability of success. And if you're working with an advisor, you may recognize that term. You may see that they'll print off or they'll show you something that you're at 70% probability of success or 90%. And a lot of times people try to get that up as close they can to 100 as they possibly can. And it's an interesting conversation I have with Alex about how maybe that's not the right goal, and we're maybe not framing that in the right way, because realistically, if we have 100% probability of success, that really is translated into we have 100% probability of underspending throughout retirement, and not a bad thing if your goal is to create the biggest wealth transfer to the next generation as you possibly can. But a lot of times that's not people's goal. So we'll get into that conversation. And then, as I mentioned, I linked a few things in the show notes where you can find Alex and his work. And then, of course, you can always go to integrityguidance.com and check out the podcast tab to see any of the past episodes that we've recorded for this show. And of course, come back in 2 weeks for the conclusion with my conversation with Alex. So until then, God bless.
Thank you for listening in and supporting this show. And if you have a moment, we'd love a 5-star review to help this podcast reach even more listeners. Also, this show thrives on feedback from its audience. So if you have any topics you'd like to hear covered or have anyone specific you'd like to see join the show, please email your recommendations to our address, hello@integrityguidance.com. That's hello@integrityguidance.com. We review every email that comes in, and we will do our best to include any recommendations you have for us. Thanks again, and be sure to follow our show so you don't miss an episode. This podcast is for entertainment and informational purposes only and is not intended as specific tax, legal, or investment advice. Lauren Sherman is a certified financial planner and owner of Integrity Wealth Management, a flat-fee firm which serves pre-retirees and retirees in search of their own work optional lifestyle.